we're going to work through a comprehensive problem that's going to help us look at how we calculate cash flow from assets from two different standpoints, and will also help us to see how it tells us about what's going on in the firm. During the year, the Michael Scott Paper Company has sales and cost of goods sold of $400 and $180 respectively. Depreciation was $50 and interest paid was $70. The firm's tax rate was 35%. Dividends paid were $40. Suppose 2020's balance sheet has net fixed assets of $3,700. 2019's balance sheet has net fixed assets of $3,500. Suppose the firm ended 2019 with $1,200 in current assets and $900 in current liabilities. The firm ended 2020 with corresponding figures of $1,325 and $975. The firm did not issue any new shares. What is the cash flow to creditors? It's important to always go to your question no matter how long or how complex the problem is. And our question here is, what is the cash flow to creditors? Now, the easiest way to calculate that, if we have all the information, is cash flow to creditors is equal to interest minus net new borrowing. If we skim through the problem a bit, we can see that we're given very specific income statement information and also very specific balance sheet information. So it's a good idea to rewrite this equation as cash flow to creditors is equal to interest minus long-term debt at the end of the year minus long-term debt at the beginning of the year. If we go through the problem, we can see that interest paid was $70, so we've got the first term in our equation. But if we continue reading through, we can see that they don't give us any information about long-term debt. So that's going to be a problem for us, and we can't pursue calculating cash flow to creditors using this method. So we're going to have to think of another way. If we look back at another equation that includes cash flow to creditors, we may think of cash flow from assets. One form of calculating cash flow from assets is cash flow to creditors plus cash flow to stockholders. If we're able to calculate cash flow from assets and cash flow to stockholders, then we can use algebra to calculate cash flow to creditors. So this could be a way to calculate our answer. The second method of calculating cash flow from assets is operating cash flow minus net capital spending minus change in net working capital. So let's go to the problem and see if we have any of that information available to us. So as we skim through, we can see that the problem gives us sales, cost of goods sold, depreciation, interest, our tax rate, dividends, fixed assets for 2 years, current assets, current liabilities, another current assets, another current liabilities, and then we're told that we didn't issue any shares. So we weren't given operating cash flow or net capital spending or change in net working capital, but we were given a lot of income statement and balance sheet information. And we know that operating cash flow is equal to EBIT plus depreciation minus taxes. All three of those components are on the income statement. So it may be a good idea to revisit the information in the problem and see if we're given income statement information enough to figure out EBIT, depreciation, and taxes. That will allow us to calculate operating cash flow, and maybe this is a route that we can pursue. So if we look here at the problem, we're given sales and cost of goods sold, depreciation and interest, and our tax rate of 35%. So since we know we're calculating operating cash flow, and that's EBIT plus depreciation minus taxes, we also know, like we said, that all of that's on the income statement. Using that information that we just read, let's see if we have enough to calculate operating cash flow. So our sales and cost of goods sold are $400 and $800 respectively. So if we're given things in a list, in this case we've got two lists, sales and cost of goods sold is list 1, $400 and $180 is list 2, and then we see that term respectively. This means that the items in both lists are in order. So sales is $400 because those are both the first items in the list, and cost of goods sold is $180 because both of those are the second items on the lists. So we plug in sales of $400 on our income statement, $180 into costs, and $50 into depreciation. We'll plug in $70 for interest, and then we'll note on our income statement that our tax rate is 35%. So now let's see what we can solve on this income statement and if it's enough to get us operating cash flow. So sales minus cost minus depreciation on the income statement brings us to $170 for EBIT. We'll subtract interest, and that leaves us $100 for earnings before taxes. Now we have to calculate our taxes. So our tax rate is 35%. We'll convert that to a decimal, so that comes to 0.35, and we'll multiply that by our $100 taxable income. That gives us $35 for taxes. We have everything we need to calculate operating cash flow. If you want, you can go ahead and write down that net income is $65, but you don't need that here. So EBIT is $170, depreciation is $50, and then we'll subtract our tax rate of $35. So if we plug that information in for operating cash flow, we end up with operating cash flow of $185. So now we have operating cash flow. Now we can focus on calculating net capital spending. Net capital spending is net fixed assets at the end of the year minus net fixed assets at the beginning of the year, and then we add back in depreciation. So if we look back at our problem, we are given net fixed assets for 2020 and 2019, and we're also given depreciation of $50. So if we use that information, we can then plug in $3,750 for net fixed assets at the end of the year, which is the 2020 balance sheet, and then $3,500 for net fixed assets at the beginning of the year, which would be from the 2019 balance sheet, and then our depreciation of $50. That gives us net capital spending of $250. Now that we have net capital spending, we can focus on calculating change in net working capital. So change in net working capital is net working capital at the end of the year minus net working capital at the beginning of the year. And we'll have to calculate each net working capital separately. So current assets at the end of the year minus current liabilities at the end of the year, and then we'll subtract current assets at the beginning of the year minus current liabilities at the beginning of the year. If we go back and look at the problem, we are given current assets and current liabilities information for 2019, and also current assets and current liabilities information for 2020. So we'll use that information to plug into our change in net working capital equation. So in 2020, current assets was $1,325 and current liabilities were $975. In 2019, our current assets were $1,200 minus our current liabilities of $900. That gives us net working capital of $350 for 2020 and net working capital of $300 for 2019. So our change in net working capital year over year is $50. Now we have our change in net working capital and we're ready to calculate cash flow from assets. So our operating cash flow is $185. We already calculated that. We also calculated that our net capital spending was $250 and our change in net working capital was $50. So we end up with a cash flow from assets of negative $115. Now that's not a mistake. It's perfectly okay for our cash flow from assets to be a negative. And if we look at the different components that we have here, remember that our operating cash flow is our cash flow from our firm's general business. So from our general business, we made $185. But then if we look at the second term, our net capital spending, we can see that we spent $250 on plant, property, and equipment. So we spent more money on plant, property, equipment, on big assets than we actually made in terms of our firm's general operations. So far, cash flow from assets should be negative. If we look at the third term, change in net working capital means that we would have invested more in things like inventory and accounts receivable, and in this case, we invested an additional $50. So that's another cash outflow for us. So cash flow from assets is even more negative. So that's how we end up with this negative $115. In this case, it came from us spending more on net capital spending and change in net working capital than we made in our firm's general operations. Now, we've said in a previous video that it's possible for operating cash flow to be negative if we end up having a loss for the year. It's also possible for net capital spending to be positive if we end up selling more fixed assets than we end up purchasing in the year. And it's also possible for change in net working capital to be positive if we end up reducing our investment in inventory and accounts receivable. So all three of these components can be either a positive sign or a negative sign depending on what's going on in the firm. In this particular case, we just happen to spend more money than we made this year. Now that means that it's going to have to come from somewhere. It's either going to come from our creditors or it's going to come from our stockholders. But one of these two groups of investors is going to have to finance this deficit, essentially, that we have here. So let's continue on with the problem and see where the money comes from. So we have cash flow from assets. We're trying to solve for cash flow to creditors. So the next thing to do is to focus on cash flow to stockholders. Cash flow to stockholders is calculated as dividends minus net new equity. If we go back to the problem, we're told that we paid dividends and we're also told that we didn't issue any new shares. We're not given any information about repurchases, so we can assume that we didn't repurchase any shares. So if we plug in the information that we have here, our dividends come to $40 and there were no changes in the amount of shares that we issued or repurchased, so net new equity is going to be a 0. So our cash flow to stockholders comes to $40. That's a positive number. That means we gave $40 to the stockholders, and that makes sense. It was a dividend that we gave them. So we gave them $40 in cash. So now we know that the deficit in this cash flow from assets is going to have to be financed by our creditors. Now that we have cash flow to stockholders, let's go ahead and calculate cash flow to creditors and see how much they allowed us to borrow. We know that that deficit in cash flow from assets is now going to have to be financed by them. So we already know it's going to end up being a negative number. Our cash flow from assets we calculated earlier to be a negative $115, and we just calculated cash flow to stockholders to be positive $40. So to solve for cash flow to creditors, we use algebra and subtract the 40 from both sides. It cancels out on the right-hand side, and we're left with cash flow to creditors is equal to a negative $155. So this means that the net effect of our borrowing and repayment activities to our creditors was a negative $155. That allowed us to spend more on the net capital spending and on the investments in net working capital, as well as pay our stockholders the $40 dividend. That's how we were able to do all that. We ended up borrowing $155 from our creditors. And as we mentioned before with the calculation for cash flow from assets, where it was operating cash flow minus net capital spending minus change in net working capital, we said that all of those terms could be positive and they could all be negative. The same applies here with cash flow to creditors and cash flow to stockholders. Both of these can be positive or they can be negative. They're going to be positive when we actually give money to these investors. So in the example of the stockholders, we gave them $40. And it's going to be negative when the net effect is that we take money from them, like in this case with the creditors. We borrowed $155 from them. Remember that negative signs always mean that it's the opposite. So even though it says cash flow to creditors, because we have the negative sign with $155, we know that it's money we took from them. So we have the answer to our question, but I hope that you noted that as we were going through and solving the problem, we were also interpreting what was going on in the firm. And it's really important for you to do that when you're calculating something yourself, whether it's a homework problem or a practice problem. Don't just calculate the answer and move on. Always make sure that you can interpret the answer and that you understand what it means. Then you can move on to the next problem.